Good evening, everyone. Welcome to our Sac State Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with everyone this evening. I appreciate you taking time out of your Wednesday evening to join us for our discussion tonight. This is a class we offer to our communities, usually once a quarter through the Sac State Alumni Network in athletics. So really excited that you guys could get a chance to be here with us for our class. Our class will be recorded tonight, so all of our content that I review over the next hour will be all up on our YouTube channel tomorrow. And as we go through our course content, really encourage you to ask questions from our audience tonight. So we'll answer those questions on air. And then what we'll do is we'll carve out some time later on in tonight's discussion if there's any questions that we got left behind. But we really try to make this more of an interactive session with you. The runtime for tonight's class will get us right up to about the top of the hour. But in this class, you're going to get a chance to learn a lot of great things around home buying. And I really think it's a great time of the year to kind of talk a little bit about home buying. A lot of stuff in the news economically, which we're going to spend some time kind of diving into a little bit. So, we appreciate you carving out some time in your busy weeks to be able to join us to learn a little bit more about this. Well, our organization, American Pacific Mortgage, is a local company here to Sacramento. So we're based out of Roseville. We've been in business for over 25 years, but we're actually a nationwide lender. So I teach classes just like you're going to hear tonight all across the country, whether it's in Texas or Maryland or Virginia or right here in California. We get a chance to present first-time buyer information all across the country. Now, the markets might look a little bit different, but I think concerns and thoughts around what do I do in home buying doesn't change from market to market. Well, a little bit about me. So my name is Jason, and I've been with American Pacific Mortgage for almost 10 years and been in the business for well over 20 years. And I specialize in first-time buying, home buying plans. And so I get a chance to facilitate classes like this, like I mentioned, all on video, and I work one-on-one with the clients, whether they're locally or clients across the country. So we're really excited to get a chance to present this content to you. And let's kind of talk a little bit about tonight's talking points. So we're going to spend some time looking at the housing market in just a little bit. We're also going to kind of dive into what are interest rates doing right now. That's probably one of the biggest topics that are on the minds of buyers is kind of what are interest rates doing? We've heard some announcements out there. What does that mean to us as a consumer? So we'll kind of dive into that a little bit. We'll also spend some time doing a budgeting exercise in just a few minutes to look at, if I continue to rent right now, what would it look like if I decide to buy, and budgeting myself for home purchase. Also talk a little bit about credit, documentation around student loans, and will those impact me from a qualifying perspective? We'll look at various loan programs that are available to you as a first-time buyer. Also talk about qualifying income and savings plans to help me on that path towards homeownership. And we'll also look at first-time buyer programs. I think most of us in tonight's call are probably in the state of California. So we'll spend some time looking at an agency called CalHFA, or the California Housing Finance Agency, centered around helping first-time low to moderate income families. And then we'll finally kind of wrap up the class looking at the buying process. So after tonight's class, you may say, hey, you know what? I kind of want to learn a little bit more about buying and what it could look like for me. We're going to show you how to start that path towards homeownership with a consultation and then designing a home buying plan to help you reach your goals of homeownership, whenever that is. Could it be this year in 2024? It could be 2 or 3 years from now. We want to make sure that our audience that attends these classes have all the tools and resources they need to help them on that path towards homeownership. All right, well, let's think a little bit more about buying. And when you think about buying as your next big financial purchase, it's probably going to be one of the biggest purchases you decide to make. And so when you're taking an hour out of your busy Wednesday nights, obviously that's a serious step in kind of preparing for home ownership. And when you think about the benefits that come along with ownership, we can create better stability with our housing budget. This is an asset that will hopefully appreciate. So when we're talking about appreciation, we're looking at the value of our home increasing over time. So if I have a mortgage balance of $200,000 and then my home is increasing because I bought that house for, say, $250,000. So as that home goes up in value, my balance hopefully decreases as I make payments. The difference between those two numbers is called home equity. That equity can turn into wealth creation for you as a homeowner, potentially generational wealth that can, change financial lives for families. And there is some really good tax benefits that come along with owning a home. So those are things that we're going to kind of plug into our calculations when we think about budgeting. Before I forget, for our questions tonight, please feel free to use the chat feature or the Q&A feature in Zoom. And then myself and my colleague Ken will be kind of watching for any questions that kind of pop in. And then, like I said, I'll answer those live on air. Well, kind of what we want to start off our discussion for tonight is to talk a little bit about budgeting for a home. And we're going to be looking at a rent versus buying calculator to kind of talk a little bit more about what could it look like if I decided to prepare for home ownership versus if I continue to go down that lane of maybe renting a home. Now, all of this material that I'm going to share with you this evening, including this next page that I'm going to bring up, is all going to be shared with you via email tomorrow. So I know we have a lot of us that signed up for tonight's class. Some of you might not have made this class, but if you didn't, it's going to be recorded on our YouTube channel tomorrow, but we'll also send out the material that we're discussing in email tomorrow. Well, let's talk a little bit about renting versus buying. And so this calculator that's brought to us by Freddie Mac, you'll learn a little bit more about Freddie Mac a little bit later in tonight's discussion, but this kind of frames up for you what it looks like in that comparison. So I'm going to kind of walk you through a what if example that we put together on screen just to kind of help you with the calculation. I would encourage you, when you get the presentation material tomorrow, take some time maybe over the weekend if you have a moment and kind of do your own calculation, because I think it will start to kind of change your perspective on what buying could look like for you as a future financial goal. So let's kind of take a look at this. If we assume that we're renting at, let's say, $2,500 a month, that's going to be our first input under this rental category. Then we have renter's insurance that we assume at $15 a month in rent. We assume that the rent will increase 5% on an annualized basis. And then that'll kind of build out our rental side of things. And then our next section is going to be around the home purchase side of things. So our home purchase will have at $500,000. We have a minimum down payment of 3%. We have property taxes that we assume. Generally, we calculate taxes as a baseline at 1.25% of the purchase price. We have a homeowner's insurance budget of $1,000 on an annual basis. Homeowner's insurance, especially in California, will vary based upon where you're at. Since most of us are probably in Northern California, there are, we call those fire zones that can have higher cost of insurance. Those are things we have to kind of keep in mind when it comes to homeowners insurance. We have maintenance costs of our home. And then around loan information, we're going to assume a 30-year fixed mortgage. We have an interest rate assumption of around 6% for a first-time buyer. And then there's origination costs. So origination costs are what the lender is charging you for your financing. Now, one of the cool things that we have as part of our partnership with Sac State Alumni is we actually discount our origination charges with the APM to provide just lower services for you in taking those next steps towards homeownership. And then discount points are when a buyer wants to pay additional funds out of pocket to help bring down their interest rate. So let's say the rate is 6.125% today, and I want to pay 1 point. Well, 1 point is the equivalent of 1% of my loan amount. So if I'm going to finance $300,000, that out-of-pocket expense would essentially be $3,000 out of pocket, and that should generally equate to about a 0.25% reduction in interest rate. Now, interest rates change by the minute throughout the trading days in economic markets. We're going to talk about interest rates just a bit, but those are ways that some buyers will choose to bring down their interest rates. Now, in today's market, I don't necessarily recommend buyers paying discount points, but everybody's situation's a little bit different. Just a quick side note, Nick, I see your question in the chat about the California Dream for All program. We're going to talk more about that later on because we have a special CalHFA segment. So I'll kind of touch on California Dream for All and kind of the status check there. So we'll get back to you on that one. And then other settlement services are going to be title and escrow fees. Those are all part of kind of under the umbrella of closing costs and prepaid items to purchase our home. Generally, we recommend buyers to budget about 2 to 3% of their overall sales price for closing costs and prepaid items. And then the last section is other assumptions. Whoops, and we lost some lighting here. So, all right, there we go. So the last section is other assumptions. And I'm going to actually make a quick little on-the-fly adjustment. I think we have our Sac State football that might be messing up our sensors for our lights. So we'll make a change on the fly. But the last section we're going to look at is other assumptions. And so other assumptions would be around the appreciation rate of my home. So how much will my home appreciate over time? We have expected years I'm going to be in my home. So we're going to say 7 years. And then we have the selling costs of our house, state and federal tax rates, and then finally the savings rate. And so when we look at our calculation, let's first look at it from a payment perspective. And so our payments are certainly going to go up from what we're paying in rent. So rent's roughly about $2,500 a month. Go to the mortgage side of it, it's going to jump us up to about $4,000 a month. So that's clearly a big step up for us, $1,500 a month in budget. However, if we look at the total opportunity over 7 years, so if I compare renting for 7 years versus buying for 7 years, I'm going to have about an $82,000 opportunity of owning that home instead of renting. Now, how did I get there? Well, I got there by looking at my appreciation over time over the next 7 years. I also get there by looking at tax benefits that come along with owning a home. So I encourage buyers, don't necessarily look at your budget from an apples to apples comparison. It's really like an apples to oranges comparison, right? Because there's a lot of benefits that come into owning that you don't realize from a rental perspective. All right. So that is our rent versus buying calculator. And I think we had a question that popped in, but I think it then dropped. So Ken's going to check back in with you on that one. And again, I would encourage you to, take some time to kind of work on this calculator yourself. I think it's really an eye-opening experience for you in planning for home ownership. We'll also help you through that during a consultation. You're going to learn a little bit more about our free consultations a little bit later in tonight's class. Well, let's take some time looking at the Sacramento housing market. Ken was actually just chatting with me before tonight's class and mentioned to me that the lowest price single family home in the Sacramento area, I think it was like $250,000. So, the prices have certainly changed in the Sacramento market. I think the mindset of Bay Area buyers coming to Sacramento was like, hey, let's go to Sacramento and find a cheap home. But I think really the Sacramento market has changed quite a bit. And I think our median prices are really reflective of that. The median sales price in Sacramento now is $500,000 for the greater Sacramento area. You can see prices displayed by this graph are kind of leveling a little bit right now. I think some of that's a bit cyclical in the market. When we look at the housing market as a whole, and we look at kind of the cycles that we go through on a 12-month calendar year, generally we see a lot of uptick in the market around April, May. So better weather in the area. We're starting to think about summertime, maybe planning for maybe moving neighborhoods for a different school district or different community, whatever the case may be. This housing market's been a little bit different, I'll be honest with you. We haven't seen that kind of like move in the buyer demand until about July, August. I think a lot of that was attributed to interest rates, which you're going to hear about in just a minute. But the cycle of buying has kind of shifted a little bit deeper into the year. So we saw, like I said, July and August being some bigger months. And I think now we're starting to see even more increased demand, given what we're going to see probably in the future with interest rates. So the challenge we have in the housing market right now is there just really isn't still a lot of inventory out there to support buyer demand. And so I do think as interest rates start to decrease, which again, we're going to talk about, more resellers or existing homeowners will come online and give us more inventory, but it's still a kind of a major issue right now. So you can kind of see what's happening right now. Homes on the market are only staying on market about 20 days. So now that was shorter when we had, a much higher or more heated housing market. But right now, homes are still kind of coming off the market because there's really not a lot of inventory for buyers. Now, I think where do we go from a price perspective? Well, I think interest rates are going to be a major component of that. So you guys probably have heard in the news last week, the Federal Reserve cut interest rates 0.5%. That was certainly a good sign for us from an overall interest rate perspective. And I think it's important to understand that the news is a bit misleading when the Federal Reserve cuts rates, because it doesn't necessarily mean mortgage rates will drop by 0.5%. So when the Federal Reserve cuts rates, we're talking about cut of rates that will impact you on your credit card rates, personal loans, car loans, lines of credit, things like that. But it will have a ripple effect into mortgage interest rates. What's interesting is mortgage interest rates are basically flat to slightly higher since the announcement on Wednesday. So a lot of what we were experiencing from an interest rate perspective leading into that announcement was already kind of baked into today's mortgage market. So I think the look ahead is really what we're going to see interest rates maybe fall a little bit on the mortgage side. The Federal Reserve cutting interest rates has also given their kind of outlook on the economy. There is a projection for potentially 2 more rate cuts for 2024. and at least 4 rate cuts for 2025. So we'll really have to watch rates pretty carefully. But here's where I think it'll be interesting for us as buyers is that as rates come down, and we're already seeing this, buyer demand is increasing. Well, the inventory component needs to be solved, because if buyer demand increases but inventory stays level, what we may see, especially in an area like the greater Sacramento area, is prices start to push up. So we'll have to kind of watch that really closely, but I think that's something you're going to have some kind of perspective on in as you're kind of considering getting into the market. This little snapshot that we have with interest rates shows you what we've seen over the last, or experienced over the last 12 months. Clearly a roller coaster ride of interest rates. Our peak interest rate was back in October of 23. Interest rates hit a 20-year high of about 8%. Luckily we've come off that high, and we've kind of got down to where we are today, represented by this 30-year blue line here. So that has us right around 6.1 to 6.25. But interest rates are kind of just a little bit bumpy right now, the market's trying to kind of find itself after the Federal Reserve rate cut announcement. So I think really the projection out is definitely interest rates going lower. I think the question I get daily is, where do you think interest rates are going to go? Well, I think, some of the outlook we've seen is that, and I think this is probably a conservative figure, that interest rates will land at 5.75 by the end of 2025. I think we'll probably get there a little bit quicker. I think by the end of next year, we're probably in the 5.5% range is my guess. And I think maybe by the end of this year, we might be finishing in the 5.8 range, given what we have kind of on the horizon with potential future rate cuts. So I think it's just going to be something we're going to have to watch really carefully. And obviously that affects buying power for all clients. Karen, I got your question in the chat here. Actually, we're going to talk about that when we get to the CalHFA portion. I know you had a question around closing costs for first-time buyer programs. Let's dive into that when we get to our CalHFA section. So we'll give you guys a really comprehensive review of that. Let's first, before we kind of move on, let's talk a little bit about what makes up interest rates. So there's a variety of different characteristics that go into interest rates. So if you've talked to your coworker or a family member about maybe their home buying experience, they may have shared with you what their interest rate is. And the interest rate is based upon market situation, but it also has a lot to do with other components, like what your credit score is, what type of product you're going to elect, how much you decide to finance, what your down payment looks like. We talked earlier about discount points. If I decide to pay additional funds out of pocket, that could influence my cost, and then, of course, bring down my interest rate. And then the term of my loan. So how long I'm deciding to, put my loan at, that could change my interest rate offering. So 30-year fixed mortgage is typically the standard right now. But in normalized markets, when rates start to come down, 20-year, maybe 15-year markets can be more appealing. So that could always be an option too for a buyer. When we meet with clients for a home buying plan, we're going to kind of figure out what the right term is for you and kind of the overall product and interest rate structure based upon the current market data. All right. I appreciate everybody's dropping their questions in the chat. And what we'll do is we'll try to kind of have everything aligned with some of the topics we're talking about, because we kind of have some comprehensive information we'll give you on first-time buyer programs. So I know, especially being in Sacramento and the greater Sacramento market, a lot of you are familiarized with first-time buyer programs, but we will dive into that a little bit a little bit closer as we get further into tonight's class. Let's talk a little bit about credit. And when I think about all the first-time buyers that we get a chance to work with, there's usually probably two challenges that come about for first-time buyers. It could be lack of savings for down payment and or closing costs, or it could be credit because maybe we're a little bit overextended or we're just trying to improve our credit. There's a variety of different things. But as we meet in sessions like this, I always like to give you some tools and resources to help you from a credit perspective. Good news is there's a lot of great resources out there for you already for credit. Many of you on tonight's class probably have some type of monitoring system that you're using. And so in doing so, you have visibility of what's going on with your credit. So when you decide to apply for a credit card or a car loan or a mortgage, you really kind of have a good idea of where you stand, right? Well, on the mortgage side of things, there is a different scorecard that we use. It's a mortgage credit score card. And there's also different scoring methods for each type of application you're going to apply for. So there's an auto financing model, there's a credit card model. So let's take a look at the calculation when it comes to mortgage. So this kind of chart over here off to the right shows you the weighting of the different score components. 15% is going to be how long have I had credit? So the more mature my credit file is, the higher my credit score could potentially be. 20% is going to be how much new credit am I trying to access? So am I opening new accounts? Do I have hard inquiries on my credit? All of those are 20% of the weighting for the score. Now, one of the things I want to just spotlight here is in working with our team to design your home buying plan, we're only going to do a soft credit check. And soft credit checks do not impact your score, but it does give us visibility to your payment history, your outstanding accounts, so we can assess eligibility. And I think that's important to know that it is a soft credit check because we don't know when you're going to buy, right? It could be this year, it could be next year, and we just don't want you to be impacted with that hard inquiry. So that's why it's always a soft inquiry. 30% is going to be, and this is probably the biggest area of opportunity for most buyers, is around credit utilization. And we're looking at credit limits versus credit balances and the percentage of those balances to those limits. Now, ideally, we want our credit balances to be at 10% or less of our credit limits. Now, most buyers that I work with are probably in the 50 to 70% range. So I would encourage buyers to at least have utilization below 50% utilization. That would be the first kind of step. But when you get into the 80, 90% utilization, that's when you're going to see a lot of pullback in your credit score. Now, one of the best ways to manage down utilization is by first taking a look at your credit card statements. Now, there's two dates on that statement. There's a due date when the bill is due, but there's also a statement or closing date on the credit card. So what I would encourage you to do is if you can get in the habit of paying down your credit cards or paying off your credit card balances before the end of the statement date, that is important because what it's going to do is you're going to allow to reduce down your balances before the credit card company reports out to the 3 agencies. And by doing so, you get a lower balance, lower utilization, hopefully improved credit score. And there's 3 credit agencies. We all know them, I think, TransUnion, Experian, Equifax. So they all report differently, but they will all get that reporting from the credit card agencies or the credit card company on that statement date. Now, the last component is payment history, and that's pretty simple. That's how I paid my bills. So the more on time I'm on my credit card or installment payments, the better my credit score is going to be. If I have late payments, they're going to be rated as 30-day lates, 60-day lates, and 90-day delinquencies. So the more severe on the spectrum my late payment is, the bigger impact I'm going to have on my score. Especially events in the most recent 12 to 24 months are going to have the biggest impact to my credit score. Now, if I had a late payment back in October of 2023, once we get to next month, that score will probably lift a little bit because now I'm outside of 12 months. And then when 2 years passes, I should see better lift in my credit score and kind of some organic growth in my credit score. Now, every loan program has a minimum credit score requirement. You can see those on screen here. So as we design home buying plans for our clients, we're going to figure out based upon your credit profile what the right product match is for you. Now, when we look at bigger events like bankruptcies, short sales, foreclosures, those events will have a bigger kind of impact to your credit score, and it could take longer time to have kind of improvement in your credit score. So while the most recent 12 to 24 months is going to be the impact, as we get further away from bigger events, you should see higher lifts in your credit scores. Now, if you're in the habit of doing balance transfers and maybe closing out an account that you don't use or whatever, I would say just take a closer look at those credit cards. Try not to close out cards that have longer opening periods. So if you've had an account for 10 years with a credit card company and you close out that account, you got to be careful because what that does, that pulls away 10 years of history out of the Bureau's calculation, especially if it's one of your higher credit limit accounts or whatever the case may be. Just be careful closing out those accounts before maybe switching credit cards and using a different issuer. Now, in lending, we look at all 3 credit agency reports. So, but we are going to take the middle credit score of those 3 credit scores. So if my highest score is 760, my middle score is 740, my lowest score is 720, from a qualifying perspective, I'm going to take the 740 score. Now, that's if I just apply in just my name. However, if I apply with a cosigner or a co-applicant and their scores are 700, 680, and 660, Well, the 680 is the lowest score between the two of us. So the 680 score is what we're going to be using from a qualifying perspective. And that's really important to understand because that could impact interest rate, product selection, down payment. And so those are all the things that we kind of talk about in meeting with our clients. So a question came up in the chat, which was, if my late grandfather was in the military, would I automatically qualify for a VA loan? Probably not. Usually it's on a VA loan, you're going to have a direct relational connection with that veteran. So it would have to be like a spouse kind of a situation in order to achieve the VA benefits as it relates to a VA loan. Now, there might be some GI benefits that you might receive in going to school or anything like that, but in terms of the VA home loan, it usually needs to be direct relationship, like I said, a spouse. All right, thank you for the question. And I want to just kind of pass along this kind of negative items matrix for you. Just if you've had some past challenges, I think it's important to understand, like, how long are they going to stay with me on my credit report? Most things will be 7 years or less, but if you do have things like public records or maybe a past bankruptcy, it can be 10 years. Late payments will be 7 years. However, it's going to be really impacting your score in the most recent 12 to 24 months from the date of the event. All right, let's talk a little bit about student loans. Those all come up in our conversations with clients, and I think I just want to kind of equip you with some information on student loans. While, I hope everyone gets, cancellation of debt, so you don't have student loan debt. At times we do have to take a look at that for qualifying purposes. So there's different ways that we look at it. By now, all federal student loan debt, unless it was canceled, is in repayment. So if you're in a forbearance right now, or if you're in deferment, as a lender, we still have to count a minimum payment for qualifying purposes. So there's a couple ways that we look at that. If you're doing a conventional loan, we usually use 1% of the total balances to calculate the payment. If you're doing an FHA loan, it's 0.5% of the total balances. So for example, if I have $75,000 in total student loan debt, if I did a conventional loan, it's a $750 monthly payment that we would have to assess. Or on a FHA loan, it'd be $375, right? Now, if you're on an income-based repayment program, that is allowed. So, I have some clients that have a zero payment for their income-based, and that's totally acceptable. Or if it's $10, whatever the case may be, income-based repayment can be used for qualifying purposes. But I think it's important, as kind of a takeaway from this section, is that if you're in deferment or forbearance, we do have to count a minimum payment into the qualifying side. Now, as we look at student loans, it kind of ties back to some of the guidelines for different loan programs. So what we like to do is kind of from a high level perspective, just give you a kind of a look into each one of these products. You've probably heard a little bit about them or maybe even done some research online, but I want to kind of give you some of the characteristics of each of these products. So let's first of all talk about a conventional loan. So when you think about a conventional loan, it would correlate with like Freddie Mac or Fannie Mae loans. The conventional loan occupies about 60 to 70% of all originated loans across the country. And so on that conventional loan for a first-time buyer, you do have a minimum down payment of 3% of the sales price. Usually for conventional loans, the minimum credit score is going to be 620. And that minimum down payment carries all the way up to a maximum loan amount of 766,550. And that loan level is called the conforming loan limit. Now, every year, based upon cost of living and cost of housing, really, Fannie Mae and the Federal Housing Administration basically kind of takes a look and says, okay, we're going to reassess kind of the maximum conforming loan limit. And so Fannie Mae and Freddie Mac assesses, what does that need to look like? Well, this upcoming year, we've already announced it. The conforming loan limit now will move to 802,000. So we've actually put that on our social media. I think it's like 802,300. I don't know exactly off the top of my head, but those are already in place for those that are using conventional loan products. Now, the FHA product has a minimum down payment of 3.5%. And that is a standard minimum down payment, goes up to the same conforming loan limits here in the Sacramento area. FHA has not released their loan limits yet, but they will. I would think in the next month or so. But with an FHA loan, and we're going to talk a little bit about a comparison between FHA and conventional, mortgage insurance will look a little bit different between those two product sets. Now, FHA has a lot more flexibility in qualifying. The FHA minimum credit score goes down to 580, whereas on the conventional product, you see the 620 minimum credit score. Like I said, we're going to do some talk around, comparing mortgage insurance on a conventional loan versus an FHA loan in our next segment. But with the FHA loan product, it's not just for first-time buyers. You can be a second or third-time buyer to use the product. I think that's kind of one of the big misconceptions with FHA. A lot of first-time buyers especially think because they're first-time buyers, they have to use FHA, but not necessarily the case. You can do conventional, VA, FHA, USDA, some of the products we're talking about this evening. The next product is the VA home loan. I know we already got a VA question that came in. Those are for our veterans that have served. A veteran would have a certificate of eligibility for that program. They can use their VA multiple times. One of the great things about the VA home loan is not only is it flexible from an underwriting perspective to help the veteran, but it also has a no down payment requirement. So technically you can buy a home with 0 down payment. You can also complement that product with some of the first-time buyer programs that you're going to learn a little bit more about later this evening. And then the USDA product, that's going to be for buyers that want to purchase in more kind of rural areas. So let's say I'm looking to buy in Placerville, right? Placerville could be considered a USDA eligible area. And the benefit there is you have a 0 down payment option with USDA. So the two big qualifiers with USDA is it does require it to be in a USDA deemed area, a rural area. And there's also income qualifying requirements, so you can't exceed a certain household income threshold based upon the area that you're going to purchase. And then finally, the last loan, which isn't super common for first-time buyers, but I want to make sure you guys understand what that looks like. And that's a jumbo loan product. Those are for clients that are looking to purchase at a loan amount that exceeds the conforming loan limit. And that usually requires a higher level of down payment, usually 10 to 15%, usually higher credit score requirements, usually 680 plus. There's also additional asset requirements in the jumbo loan product. So usually for most products, we have to save up for our down payment and our closing costs. But on a jumbo loan, there's also additional assets like reserves required on that product. And reserves are basically additional assets that I have like in a 401k or 403b or just cash account that give me extra liquidity for my financing. So usually the reserve requirement is 12 months of my monthly payment. So if my mortgage payment is $8,000 a month, I would have to have additional $96,000 in assets above and beyond my down payment and my closing costs. All right, I got a couple questions in that came in, so I want to kind of take those. Then we're going to talk a little bit about PMI. In what instance would you want to go conventional instead of FHA? Well, it just depends on your qualifying, and that's a conversation we'll have with a client. In fact, I had one of those conversations this afternoon, looking at a conventional loan versus an FHA loan. And, I think for most of my clients that need to go FHA, it would be probably clients in maybe lower credit ranges, maybe 660 and below, because when you look at mortgage insurance, which we'll talk about in just a second, FHA tends to be a little bit cheaper for clients if they're in maybe a little bit lower credit score levels as opposed to conventional loans. So that would be an instance. If you're putting significant amounts down, like 20% down, definitely would not want to go FHA, because regardless of me putting 20% down or not, FHA is going to have mortgage insurance. Okay, and I'll spend some time in that in just a minute. Another question that came in, which is how do you find out if the area you are wanting to buy in would qualify for USDA? So certainly you can connect with us, offline after our class. We can give you, there's a USDA website, and you can just type in the address and it lets you know if it's USDA eligible or not. Ken might be able to put it in the chat for us. If not, we'll send it out as a follow-up tomorrow. All right, so when we purchase a home and we put less than 20% down for most products, we pay what we call mortgage insurance. And mortgage insurance takes different forms. There's government insured mortgage insurance, which is on an FHA loan. There's also private mortgage insurance, or PMI, which is on a conventional loan. And the mortgage insurance is designed to basically insure the lender in case of default by the buyer. So it is required on most loans, and so I think it's important as a buyer to understand what are the components and the budgeting that goes into mortgage insurance. So first of all, there are different payment options for conventional loans. You have the option of paying it monthly. You can pay a split premium where you pay some of it up front, some of it monthly. You can do a single premium, which is where you buy out the mortgage insurance in its entirety, or you can have it kind of built into your interest rate. So if rates are 6% and you elect to take a 6.5% rate, maybe you could buy out the mortgage insurance. That's not a really popular option. The popular option is really the monthly mortgage insurance scenario. And the reason why that is because mortgage insurance on a conventional loan has a cancellation option. So once I reach 2 years in that loan and I have 22% equity, I can apply to have the mortgage insurance completely canceled. Now, if you've already started doing some home searches on Redfin, maybe Zillow, and maybe you've kind of messed around with some of their calculators, what you'll find is those calculators can kind of inflate mortgage insurance a little bit. And the reason why that is because they don't have that calibrated to match up this next section, which is around the different characteristics that go into mortgage insurance, like credit score, how much I put down, and then ultimately how much I finance. So if I have a 800 credit score and I'm putting 10% down, I'm going to have a much lower mortgage insurance premium than if, say, I have a 740 credit score and I'm putting 3% down. The last thing on the conventional mortgage insurance that's really important is that it has a cancellation option. And so we talked a little bit about that. So when we compare this to the FHA product, FHA unfortunately does not have a cancellation option, but one of the big motivators for many clients using conventional is because of the cancellation component. And let's look at an example here on screen. So if I finance, let's say $450,000, and I had a credit score of 740 and I put down 3% for my down payment, my mortgage insurance is going to be about $183 a month. So probably a lot less than what you're seeing in some of your calculators online. Now, from an FHA perspective, let's look at the different payment options there. So it looks quite a bit different. So there's monthly mortgage insurance with FHA, and that's at a factor of 0.55% of the loan amount. And then there's upfront mortgage insurance, which is 1.75% of my loan amount. Now, regardless if I put 20% down or I put the minimum of 3.5% down, there will always be mortgage insurance on a FHA loan. Now, this, again, can only be canceled through a refinance. So generally what most clients will do is use the FHA if they need to go down that path to enter home ownership. And eventually down the road, maybe 2 or 3 years, we're looking to refinance into a conventional product. So if we look at the same scenario, so the same loan amount, $450,000, now we're going to add in those two mortgage insurance components. So the upfront mortgage insurance of 1.75%, which is $78.75, and then we have the monthly of $206. So those get kind of added into the FHA equation. So you can see the FHA mortgage insurance slightly higher than conventional loan. Clearly, the upfront is a big difference maker between that and the conventional loan. So again, I think it goes back to the right product fit. And so, most clients would want to go towards the conventional product, but it doesn't always necessarily work that way. And so we'll figure out the right design for you in your home financing. Last thing I wanted to mention, because this actually came up in a discussion with a client earlier today. When you do rate searches online, you'll often find that interest rates on FHA loans are significantly lower, maybe not significantly, but at least 0.5% lower than conventional loans. What is kind of misrepresented is that you don't understand when you're looking at those rates that there's different expense structures, right? So hopefully from tonight's class, one of your takeaways is when you see an FHA rate, knowing that it has a higher expense ratio to it because there is a higher mortgage insurance component to it versus a conventional loan. So that's one of the big difference makers when it comes to interest rate and then expense structure. Question came in, which is, do you typically end up paying more over time if you put less than 20% down and pay PMI versus putting putting less than 20% and paying PMI versus putting 20% down and no PMI? It just depends on where you enter from an interest rate perspective, would be the big thing now. Some clients, especially that are buying in today's market, will probably be refinancing in a year, maybe 2 years down the road. So, I think those that are choosing to enter the housing market, whether in the next year or two, I think ultimately you're probably going to refinance into a lower rate product at some point. So I think that would probably be a conversation for the next loan more than likely. But, I think if you took side by side in today's market and you didn't do anything different and you put 20% down, versus doing, say, 10% down on PMI, you're certainly going to pay more over time on the 10% because your borrowing costs are much higher. All right, one of the things we look at in qualifying is income, right? So we kind of look at credit, we look at down payment, we look at the type of property, we also look at income. And so I just want to provide you a real simple checklist of income documents. So if you're thinking about getting on that path towards homeownership, wanted to kind of share with you the typical documents that we'll ask for. Usually the last 2 years of W-2s, we're going to ask for recent pay stubs, and then from an asset perspective, the last 2 months of bank statements. Now, in verifying employment history, we always have to verify at least 2 years of history between employment and or education. And I think the education part is really important. So if you just graduated from Sac State, you spent 4 years at Sac State in undergrad, and now you're in the workforce, maybe you're working for the state of California or some private sector job, as long as you can show 2 years work and or education history, that meets qualifying standards for financing. So you don't have to necessarily be on the job for 2 years. We just have to show 2 years work and or educational history. Now, the 2-year rule is kind of more important is that if I have dual roles, like I have dual jobs, sometimes we see this in the healthcare industry, where if I have a client that's working at 2 different facilities, in that case, I do have to show that I've been on both jobs simultaneously for the last 2 years. With part-time employment, it's very similar too. So if I have a job that's a part-time job, I do have to show that I've been there for at least 2 years in order to meet qualifying standards. And if I'm self-employed, so if I'm a sole proprietor, I have to show that I've filed taxes as a sole proprietor for the last 2 years in order to meet the qualifying standards. So other questions that kind of come up from our audience in classes will be around, side employment. So if I have a 40-hour work week job, but I drive for Uber on the weekends and I want to include that income into my qualifying, you can do that. We just have to show that you've been working your full-time job and simultaneously being able to handle the Uber work simultaneously for 2 years. And the question came in, which is, do you have to be on the same job for 2 years? You absolutely don't. So, I have some clients, like we have a client right now that's transferring out from Colorado to California, starting a new job here this week. We're actually using that new job verification to qualify them for their home purchase in California without having 2 years on that job. So you can certainly make a move without having 2 years on the job. So question is, what happens if you have a unstable job like an adjunct teaching for many years and then get a full-time stable job for 6 to 12 months? Will I still need to have the 2 years of stable job that can afford this mortgage? So I'd have to kind of talk through that a little bit more with you. But if you get hired onto a full-time position and let's say it's a 12-month contract. So most of our teachers, for example, or professors are going to be on a 12-month based upon the school year. So if you have that 12-month contract, that should be okay from a qualifying perspective. Now, one of the questions that comes up is additional income from, say, a partner or spouse that's contributing to the household. So in order to count that additional income to help me budget for my home purchase, that person would have to be part of the application in order to meet qualifying. And another thing that pops up is sometimes is room rent. So if I have a roommate right now and the roommate's contributing $500 to my housing budget, unfortunately, most programs are not going to allow you to use that income unless you're buying kind of more of an investment or multi-family type of property. All right. Let me take a question and then we'll kind of keep things moving. We'll talk a little bit more about income, but the question is, if I've been on maternity leave, how does that work? So if you've been on maternity leave and you're going to return to the same job, there's a couple different ways we can look at that. We can just do a verification to verify that you're going to get back to work at the same level of hours and same capacity, and then we just take your normal earnings. It depends on your return to work date, honestly, on how we're going to look at that. Or if you're looking to qualify right now and maybe you're not going back to work for 6 months, then generally we would take you're probably receiving 60% of your earnings potentially, and then plus you're receiving maybe state disability. We can factor those into the qualifying income. But for most of our clients on maternity leave, we're going to look at when they're returning to work, and if they're going to be in the same capacity, we can use their normal earnings. Now, one of the income pieces that I think is pretty important is looking at an expense analysis versus expense ratio to income. And so that's called a debt to income ratio. And you may have heard about that calculation already, but it's looking at gross monthly income versus monthly expenses. Your typical expenses like credit cards, personal loans, the expected mortgage payment for the house, all of those things, we look at those expenses versus our monthly income. Generally, we don't want those expenses to exceed more than 43 to 45% of our pre-tax income. Now, at times we can go as high as 50%, depending on the overall profile for the client, but usually it's about 43 to 45%. So the calculation looks like this. So we look at our housing expense and we take a look at our principal and interest of our loan. We look at the property taxes for the house, the homeowner's insurance, if I'm paying PMI or mortgage insurance, and then maybe if I'm buying a condo or a townhouse, we look at HOA expenses. And then we add those together with our existing expenses. Now, things like daycare expense or our travel budget, all that stuff doesn't get factored into this analysis. It's just more so debts that appear on like a credit report. So in this particular example, we have a client that has a $2,500 mortgage payment, $500 in expenses. So we have a total sum of expenses at $3,000 and then income at $8,500. So the debt to income ratio lands at 35.29%. So the question I get often is, well, Jason, where should my debt to income ratio be really for me? And it really depends on each client that we work with. I will say the comfort zone for debt to income ratio tends to be around 33 to 36%, somewhere in that range. But in some cases where we have maybe income that we can't totally verify, we do have clients that are budgeting at 45 to 50% on a case-by-case basis. I would say the most important thing when we look at budgeting is to look at affordability. And so there's two kind of big goals for us in designing home buying plans for clients. One is it has to be a sustainable plan that can, stand the test of time, so to speak, but also affordability, right? Because we want to make sure you're getting into home ownership where it feels affordable for you. So if things do happen to you financially, you can kind of weather the storm, right? Now let's take a look at savings and really the assets that we're going to need to get into home ownership. And so I want to kind of first talk a little bit about documentation, spend some time looking at a savings plan. And I know we got a few questions when we started class around assistance programs. So we'll kind of spend some time looking at that. So from a documentation perspective, we generally need the last 60 days of checking in savings account statements. If you're going to use your retirement, 401ks, 403bs, those can be potentially used. I would encourage you to talk to your financial planner or your tax advisor before you access those assets, so we don't create any type of tax events for yourself. At times, family members will contribute to home purchasing, and that's totally fine. Those are called gift funds. There's a documentation process to that. Those funds in gifting do not need to be seasoned, but they need to be paper trailed through the process. So cash deposits, anything like that cannot be used in a home purchase. Everything used in a home purchase has to be seasoned at least 60 days unless it's gift funds. Now, you probably heard me mention earlier about the two challenges for home buying, right? It's either credit or it's around savings for home ownership, and those are real challenges. Assistance programs can certainly help substitute the need for assets to purchase a home. But I think as you're preparing for home ownership, I like to kind of give you like one action item for you, or maybe kind of a discipline that you can put into your finances. And it would just be a really simple savings plan. And I worked on one with this with a client earlier today. And it would go like this. So if I'm paying right now, let's say in our example, we were paying $2,500 a month in rent, right? But I feel like I can take my home buying budget to about $4,000 a month. So right there, we have about a $1,500 variance. So if I'm kind of short on savings right now, but I'm trying to build up to a home ownership, what I would encourage that client to do is to start paying yourself from a savings perspective, like you're making the $4,000 mortgage payment. So as I pay that payment to my landlord for $2,500 a month, let's take that additional $1,500, let's transfer that to our savings account and do that on a monthly basis. And as we see over the next several months, at the end of 6 months, we have 9,000 built up. At the end of the year, we have 18,000 built up. And that doesn't even include interest that could accrue on that savings. And then that allows us to kind of grow that savings account for home ownership. So it does two things: creates that discipline of paying that higher level of payment, and hopefully helping grow that savings account. Question came in, and we're going to talk about assistance programs, but can the down payment come from a business account? It can come from a business account. There's a way we have to document that. We have to make sure that, accessing funds out of the business account won't, deteriorate the liquidity of the business. So at times we may need to have a CPA letter or CPA write a letter that indicates that it won't change the health of the business. So I know we've been asking about assistance programs, and since most of us are in California, we're going to spend some time talking about CalHFA, or the California Housing Finance Agency, which is designed to help low to moderate income households in homeownership. We're proud to be the #1 partner of CalHFA across the state. So we get a chance to lend the most first-time buyer assistance in the entire state. Now, many of you have been kind of familiarized with CalHFA because of the Dream for All program. It was in the news, I think 2 or 3 weeks ago. Gavin Newsom was talking a little bit about a new introduction to the California Dream for All program. That's a little bit ahead right now. It's not under development yet, but we have had 2 waves of funding for the existing Dream for All platform. Dream for All kind of 1.0 was out last year. I was a part of the team that created that program. That was a really successful program. It went under different changes and iterations, and now we have kind of the 2.0 version, which we're in the middle of funding right now. Vouchers were released on that program June 26th, and so buyers are actively using those vouchers. So about 1,900 families will achieve homeownership using that program. That program is a shared appreciation program, providing a buyer 20% of their purchase price or $150,000, whichever is less. The question I get often right now is, when is Dream for All coming back? And so there is no plans for another release of Dream for All, at least yet, because there is no state budget for it. So if we do get information on the program being released in 2025 or 26, we'll definitely let you know. You'll be part of our network here, so we'll definitely let you know, and also have that on our community channels as well. But what's available now are some of the programs that we really do a lot of, which one is the MyHome Assistance Program, which provides up to 3% of your purchase price in assistance, or 3.5% of the purchase price for an FHA loan. So if we were to look back to our loan program section, it basically covers the minimum down payment for those 2 products. And what this is, it's a separate loan that the state creates for you at a 1% simple interest rate loan. And it does not require monthly payments. In fact, you don't have to pay that back until you either sell the home or if you decide to refinance in the future. So a great program. That's probably one of our most popular products. It's always available. It's always part of the CalHFA budget, so it never gets overfunded or expires or anything like that. The next product is the ZIP Assistance Program. ZIP stands for Zero Interest Program. It's essentially providing you 2% of your loan amount in assistance, interest-free. Now, important to note on this product, it's in addition to the MyHome Assistance Program. So you first have to take advantage of the MyHome Assistance Program. If you still need additional resources, then we can add on ZIP Assistance. That being said, ZIP Assistance does elevate the cost of interest for the first-time home buyer. So today, the CalHFA conventional rate was 6%. If we elected to add the ZIP Assistance Program, it would push the mortgage rate over 7%. So in today's market, not necessarily the best fit for ZIP, but certainly the MyHome Assistance gives you a huge advantage. So not only is it providing you a really great resource there for a down payment assistance, but the rates generally are about 0.25% lower than the market rate. Here's an example of how CalHFA would be implemented in a conventional loan purchase. So if I was buying a $450,000 house, if I went standard with my purchase, I probably would need about $22,000 to $27,000 when we take into consideration the down payment requirement, closing costs estimated at 2 to 3%. I probably need about $22,000 to $27,000. However, if I took a look at using the first-time buyer program, now I'm going to have about $13,500 to substitute in for my down payment resource, right? And then in that scenario, if I just use MyHome Assistance, maybe I only have maybe $9,000 to $13,000 out of pocket, much more attainable than having to come to the table with $22,000 to $27,000. Of course, the ZIP can also be an answer to augment some of those closing costs as well too. So, most of our buyers that come to us don't really have the savings needed to put down the 10 to 20% down, maybe even the minimum 3% down. So that's where the CalHFA Assistance Program can really be a huge resource for you in making homeownership maybe not a 2 to 3 year goal, maybe it's a 2 to 3 month goal for you. Now, there are income limits, and so we wanted to kind of spotlight that for you. In Northern California, there are income limits based upon county. So if you're in some of our Southern California or Bay Area markets, we can get those to you as well. But these income limits are generally based upon 150% of the median income. So one of the huge attributes of this program is when you compare this to other first-time buyer programs are usually capped at 80% of the median income, or CalHFA goes up to 150%. And you do have to be a first-time buyer to participate in these programs. The definition of a first-time buyer is someone that hasn't owned in the last 3 years. And the program does have minimum credit score requirements. So for an FHA loan, the minimum score is 640. Conventional loan, it's a 680 score. We talked a little bit about debt to income ratios. So the accepting rates are 45 to 50%. And with this program, it's a little bit unique because we only look at the applicant income. And here's what I mean by that. If I'm going to apply in just my name, and let's say I make $150,000 a year, but maybe my partner makes $100,000 a year. Well, if we apply in just my name, then I could achieve eligibility under the first-time buyer program, and that income is not considered in the income limits. Now, this is eligible for one-unit properties, which would be single-family homes, condos, townhouses. Even manufactured homes can be considered. However, it has to be a manufactured home that is on land that is owned. Okay. I know we had a question around closing costs on first-time buyer programs, so I just want to make sure I touch on that, and then we're going to go into some workflow. With the CalHFA program, the ZIP assistance program would be something you could use for the closing costs, or the MyHome assistance program. So generally, what most clients will do with that first-time buyer program, MyHome would cover your minimum down payment, and then the clients would just generally have closing costs out of pocket, and that's where I'd say I would budget 2 to 3% of your purchase price. Closing costs do vary based upon also what is negotiated with the seller. All right. Okay, I know we're getting close to the top hour, so I promise we'll get you through the process side so you can get a good visual side idea of like what's the process look like for homeownership. So after tonight's class, if you're thinking about kind of pursuing homeownership and would like to be on that path towards homeownership, this is kind of what it looks like. The first step would be connecting with me for a consultation. That's a 30-minute session I do with clients all across the country to design a home buying plan for them. Now, once we're done with that free consultation, we hopefully get to a place where we've set some goals and objectives for homeownership, and then we issue a pre-approval for you so you can start shopping for homes. Now, you don't have to shop this year. It could be next year. It just gives you a baseline for qualifying. That pre-approval is usually good for 60 days, and it can be recertified at any time. So a lot of our clients that we're meeting with right now maybe not have time to buy in 2024, but they want to plan for 25. Totally okay. We just want to make sure they have all the tools they need. Now, from there, we move to house hunting. That's where you get a chance to maybe take a look at homes online now that you know your budget. And then when you feel like you're in a good space where you want to start looking at some homes in person, you can partner with a local realtor to take a look at homes. Now, we have a network of preferred realtors across the country. We have realtors right here in Sacramento that are specialized in first-time buyer programs that we can connect you with. Now, you may have heard about the changes in realtor commissions that kind of just went into play over the last 3 weeks. So we would encourage you to talk to your realtor, whoever you decide to partner with, about how that commission agreement would be set up. But ultimately, the changes in those commissions give a little bit more transparency to the buyer and seller about how realtors on the buying side are paid, and they can negotiate who is paying for those commissions. Now, from step 2, we go to step 3, and that's once we have an accepted offer with a seller, and that's called entering escrow. So that's step 3, and that kind of starts this processing of the loan. Usually from the time of accepted offer to the time I get my keys, it takes about 30 days to close escrow on a home. Now, we do have shorter time periods depending on what's needed for the buyer. We can actually shorten those closing time periods to as short as 14 days. But at step 3, we have an accepted offer. And then it creates some action items for yourself. Now, before we start doing those action items, you'll get a call from us congratulating you on your accepted offer, because sometimes that's kind of half the battle, is just getting an accepted offer. But your next step would be for you is making your earnest money deposit, which is usually 1 to 2% of your sales price. That usually is deposited to the escrow company within 2 to 3 days. And then when I have that initial call with you, we'll schedule you for your follow-up consultation. That's where we get a chance to kind of get back together on video, just make sure that we reaffirm all of your financing, make sure you understand the current interest rate, your out-of-pocket expense, your monthly payment, all the important ingredients to your home financing. Now, this is what an earnest money deposit looks like. Ultimately, an earnest money deposit is your kind of initial investment into the purchase. It is held in escrow while you go through your investigative work in the home purchase. And that includes the contingency period. The contingencies are usually from day 1 to about day 17 of the contract, which allows you to get your house appraised, to make sure the house is worth what you're buying it for, get your house inspected, get your loan approved, and all those during the time period, your deposit is completely protected during that investigative period. So you're essentially doing your due diligence at that time. Now at step 4, we're doing all the administrative work on your loan. We're verifying your employment. We're probably locking in your interest rate depending on the market conditions. We're getting everything prepared to go to the underwriting system. And the underwriter at step 5 will get a chance to approve your loan, and then issue an approval on the loan. That also will take you up to the end of your contingency period. So if your investigation works for your inspections is good, your appraisal checks out fine, your loan approval comes in, then you're going to be okay to lift your contingencies on the transaction. Now, that does also tell the seller that you're ready to move to the final stages in the process. And as a lender, we're going to issue to your final closing disclosure. That gives you a 3-day cooling off period before you move to the final stages of the process. Now, there's different iterations of disclosures that come to you in the home buying process. Everything is done electronically. However, at the very end, in the closing process, you will be signing loan documents in person with a public notary. That process usually takes about an hour or so. At that same time, you'll be wiring in the final funds for your home purchase. That money gets reconciled by the escrow team along with the funds for your home mortgage. And then once that's all been reconciled, then they record documents with the local county recorder's office. They record a grant deed to transfer ownership to you, as well as the deed for the new loan that you're taking out. And once everything gets confirmed, then we get a chance to give you our most favorite call of the day, which is to congratulate you that you've now become a new homeowner. And I get a chance to do that a couple times a day. It's the best part of my day because it's such a rewarding experience for the buyer to go through this process to now be a homeowner is a really big event in their life. And again, it's going to be one of the biggest financial purchases you decide to make. And again, taking time out of your busy schedule to be in a class like this to understand more about it, hopefully is equipping you with all the tools and resources that you need for homeownership. Well, we're getting towards the end of our class, and as we kind of get towards the end, I just want to kind of let you know a little bit more about what next steps might look like for you. So if you do want to get connected for a consultation, it's a real simple 3-step process. It includes completing an online application. We only do a soft credit check, as I mentioned earlier, and then you would upload proof of income and assets. After those 2 tasks are completed, then we get you scheduled for a consultation on video to meet with me to design your home buying plan. It's a free service we provide to our communities in homeownership. Now, if you have questions after tonight's class and maybe they didn't get answered in tonight's session, you can always schedule an introductory call with us. We'd love to be able to kind of make sure you're getting all the right information. And this is kind of what the consultation looks like. Understanding, where you want to buy, what's the interest rate market look like for you, budgets, the different products that are available, is the assistance program the right fit for you? All those things we'll explore during that consultation. And here are some of the other resources we have available to you, like our mobile app. You can start the application process right there. A lot of our clients decide to use that for calculations. So when they're out looking at homes, they can run payment calculations and get a really good detailed figure of what that house is going to cost them. Also follow the progress of their application. Now, as part of our partnership with Sac State Alumni and Athletics, we do offer a discount in closing costs, like I mentioned earlier. And if you're joining us just through some of our other affiliations, there's other partnerships that we have that also pass on a very similar discount. And if you've enjoyed tonight's class, I'd love for you to refer us to friends, family, coworkers that would love to kind of participate in these classes. We're at least doing a class like this once a week. I think we have at least probably 10 to 12 classes left on the calendar for 2024. We want to be a partner for you in home ownership. So when the time is right, you understand what resources are available to you. And here's all my contact information. So if you have any questions about tonight's class or anything like that, or just want to get connected with me, feel free to reach out, and we'll try to update everything on our social channels. We not try to, but every week we update our socials with some useful things that can help you in home ownership. And so we'd encourage you to follow us at JMaida Mortgage on Instagram. Now, as we get to the end of the class, I do want to take a few of the questions. I know we're a little bit over time, so for those of you that are still hanging on, thank you so much for that. I'll promise to get to all your questions. And so we'll dive into that now. And the first question I have is on owned land. Does that mean that it's paid off in full, or could it be a loan purchase of a land that is zoned for a home, and then the home for manufactured is on top of that loan. So I think your question more is around manufactured home purchasing. So when you purchase a manufactured home, it's going to have to be already on existing land. So when you purchase that property, it has the existing owned land, and then manufactured home is already there. It's already permanently affixed. What we can't lend on is manufactured homes like in a park. That's where it gets challenging, because in a park, it's considered personal property, which is not eligible for the type of financing that we offer. There are lenders that do that, but they generally have a much different financing package. Another question, is it more beneficial for a buyer and seller if purchasing a home without a realtor party to party? It just depends on the situation. I think you're going to have to, figure out what works best for you. I encourage you to use realtors and transactions. If you have a private party sale, it might be easier to just maybe use a real estate attorney, but it really just depends on what you're comfortable with from a legal perspective. If you're doing a family sale, then maybe it's not necessary, but it really just depends on your comfort level. Right. And I think just to that point, just to kind of dovetail off that, I think in general, using a realtor is beneficial. I mean, because you do have the opportunity to have a person that should be an expert in their market, should be really strong in negotiations, understand the market, understand all the community attributes that you're looking for. So I think using that advocate like a realtor is a huge resource for you, for sure. All right. Any questions from I know we tried kind of wove in some questions throughout tonight's class, but any other questions from our audience? I know there's quite a few of you hanging out there still. Any questions I can help answer? Let me just double check the chat. Okay. And just as a side note, Ken put the USDA eligibility link in the chat. So thank you for that, Ken. Thank you, thank you, thank you. Love it, love it. All right, cool. I think a couple more questions popped in. Another manufactured home question is, manufactured homes, can you use this process to buy a brand new and land? So not exactly, because those are two kind of acquisitions. One is you have to acquire the land, and then two is you have to go buy the new manufactured home. So it's really difficult, especially as first-time buyers. I get that question a lot, because when you purchase land, you have to at least put like 40 to 50% down for the down payment. And the biggest challenge is trying to get financing for the land. And then you provided limits of loan amounts of around 768 for FHA and conventional loans. Is this a limit of how much the purchase price could be? No, so the limits we showed earlier in the products section was the loan amount. So the purchase price there's no limitation on purchase price. That's just the maximum loan limit based upon those products. And again, for conventional loans, Fannie Mae, Freddie Mac, that conventional loan limit is going up to 802 effective now for most products. All right, thank you for that question. All right. Well, if I missed anything, I think I see a hand raised. Yes, the session is being recorded. Yeah, absolutely. And that'll be up on our YouTube channel tomorrow. And then when will the next class be? I need to, if you go to mortgageeducate.com, which I have on screen, you should be able to see all of our upcoming classes. We do have another class tomorrow night, primarily for the Southern California markets in partnership with UC Irvine. But Sac State specific, I'll have Ken, I'll kind of defer to Ken on that. He can send you guys out the class schedule, but these classes are always rotating throughout the year. All right. All right. Well, thank you so much for attending our class. I wish you all a wonderful Wednesday night, and I hope to get a chance to connect with you in maybe a future class or for your upcoming consultation. Have a great night.